or New York City, as opposed. The asset level, there are three main variables. Again, what asset class you are in, and the quality of the asset. Still, assets that are well located, that cater to specific consumer, and they're good quality and appeal to tenants. Those assets will perform or will perform before other assets, right, of less quality. And then the sponsor. It's very important that the sponsor, which is the active investor in real estate, right? Most of you are passive investors because we all have a full-time job and we invest passively in some investments. So these investors that are active and the sponsors, it's very important that they are always thinking creatively in understanding what's going on the economy, on the submarket, and on the asset level. So is my investment maximizing opportunities? I don't know, but I have a couple of suggestions here of how to maximize opportunities, even if your asset class or your asset is not performing as intended because of what we discussed. So changes in the whole period is a big one. Sometimes selling an asset before it was meant to be helps, or doing a recap, or repurposing, or things like that. So responding to the needs of tenants in the area is very important, and being very creative about it. So the question is your sponsor creative and fast to react? That's an important question we need to be doing ourselves. So here's I'm going to talk. This is basic reporting based on investments that you have invested in as passive investors. So here, this is not a comprehensive list of items that need to be addressed in a report. However, this is a good list of things that you need to be looking at on basic, better, or best reporting. So best reporting usually include evaluation of the asset, quantify risk, have audited financials, and identify systemic risk, the Fed interest rates or what's doing, and try to predict a little bit in time. Although it's impossible to time the market, at least having information that can tell you how the market or what direction the market is going helps a lot to make those decisions. Not as good, not a gold standard, but next in line. Your report should have submarket data, and I'm going to talk a little more details what to look on the submarket data specifically. There's a lot of good information out there. CoStar is a pretty good source of information most real estate professionals use. It is expensive subscription, but there's also JLL and CBRE and others that publish very good information on the specific submarkets, and you can see that. So submarket data is important. Capitalization highlights have your capital stack changed or should change, right? Should you recap this building, or should you refinance, or bring another equity partner? I mean, if your asset is not performing, or if your asset is performing, should you exit? Is this a good time, right? So understand all those things, and performance. How a good report should compare where were you supposed to be, where you're at on the cycle. And of course, basic stuff as financials, distributions, reserves, qualitative data, CapEx, forward-looking statements are important on those reports. Something here going on. Okay, I got it.
Would now be a good time to interrupt for a few questions, or would you like to hold them to the end?
Yeah, let's do that.
All right. I have a couple of questions up here. I believe the first one was a question on which REI sector do you think is the most poised to do well in the near future? Looking for that.
Yes. It's difficult to predict. What I think is going to happen right now is that a lot of investors are getting on a low cap rate. That means they're buying high on most asset classes, right? Say industrial, for example, at a 4% cap rate. So if the interest rate raises, or the Fed raises the interest rate, and then investors will not longer be happy with a 4% return on their money. They will probably would like to see more of a 6%, 7%, or whatever. And that means that the valuation of your asset came down. So I think it is important to be creative again. And I think the asset classes that will perform better on the long run will be build to rent, multifamily that caters to changes on lifestyle, some recreational property, right? For example, housing near the wine country, or housing more community housing, tiny homes in certain areas. So I think cater to the changes in lifestyle on residential specifically will be important on this new scenario.
All right. Nevin is asking, how does the San Francisco Bay Area differ from these trends?
Well, I'm not really too familiar with the San Francisco Bay Area, but I've read a little bit about it. And I think what's going on in San Francisco is that prices are so high now, that a lot of people is leaving the city, right? For one reason, for one side, that's what I understand on multifamily. And what happened is that this market peaked at a certain level where everybody wanted to be there. Now companies are starting to leave, and there's I understand that a lot of people that used to live there where prices were super high, the cost of life there, and now they can work remotely, so they're leaving the city. So I think the situation in San Francisco, as far as I know, I am not an expert on San Francisco market, but my understanding in San Francisco is that it peaked already, and people is now leaving the city and going to live elsewhere, and some companies are following.
All right. And then one last question here. Anita says, recent data is showing that with the increased vaccination levels, folks are starting to come back to urban areas. How will that modify your asset trend?
Can you repeat that question, please? Sorry, I didn't get that.
Sure. Anita is saying that people that are vaccinated seem to be moving back to urban areas. How will this affect your overall opinion of the trend?
Yes, I agree. There are certain areas where people is returning, but not. I mean, let's go and put an example. New York City, right? People massively left New York City when the pandemic started, right? Because you didn't want to get on the subway. You had to. Everything is cramped there, and if you live in a small apartment in Manhattan, and you're usually on a normal life, you don't spend all day on your apartment. Now you have to work remotely and spend all day on a small apartment. So people started leaving those big cities. Now that vaccination rates are increasing, yes, there's people that is returning to those cities. However, not on the same amount that people that left. So in most big cities, the balance is negative. Is people more people moving out than people moving in. Is this going to absorb all the vacancy that is there? I don't think so, but really no one knows.
Okay, and that's all the questions we have for right now.
Okay, good. Thank you, Daniel. And thank you for the great questions as well. So I'm going to continue a little bit about the submarket, what type of things you need to be looking at when you look at the submarket. So there's the submarket is supply and demand, right? And for example, on the question of what's going to happen when people get vaccinated, start returning to the downtown areas. So what do I need to look at? What variables do I need to look in to see how things are trending? So if we want to see supply, we need to look at inventory and new construction, right? How many units there are? Let's say we talk about San Francisco. What's the inventory now? How many living units there are, and how many are in construction? So what's the total supply, and what is the vacancy rate? Is it increasing? What's the trend, right? So those things are important to look at when you look at specific submarket. And by submarket, I don't mean a city, but every city has different submarkets. Even a downtown on the city can be divided in sometimes 4 or 5 different submarkets. So a specific north part of these submarket, like Embarcadero in San Francisco, right? And they have very defined borders where that submarket is. So specific submarket, what's people doing? What's the supply doing? Demand, net absorption. Net absorption is the people that is filling those apartments or office or retail, whatever the asset class is people wanted to rent space, right? But it nets out the people that is moving from one office to the other office, is new entrants in the market. So rents variation, that tells us a good story. What's going on with if rent rates are decreasing, that probably signals a decay in demand. Vacancy, of course, and concessions, right? When you start seeing that apartments are given 1 month free rent or 3 months free rent, or whatever concessions they give you, that signals that the market is suffering. Some concessions in office is that I've seen is a lot of office landlords are giving huge TIs or tenant improvement dollars. So when companies move to an office space, the landlord usually pays a little bit of the interior remodel of that space. Now the incentives have grown a lot, and I actually have seen people or companies that are subleasing their space. They're actually paying for TIs to the sublessors to get them interested on subleasing their space. So there's a lot of that going on, and in your specific submarket, it's important to look at these variables. If you look at these variables, that tell you the whole story. And there are some leading factors of these, specifically population, income, employment, affordability, and disposable income if you're in retail, traffic volume if you're in retail, specific traffic volume on the corner where your center is, for example, manufacturing volume, e-commerce volume. All those factors are leading factors to specific asset classes. So important to look at that. Now let's go to the deal level. Let's all remember how a real estate investment works, right? When you get in investment, you put up some money, right? And the sponsor will get money from passive investors, will get some debt as well. And with all that money, they will go and acquire that asset. In almost all cases, that asset will not produce enough cash flow to return that money that was invested plus interest if the asset until the the exit time of the asset. Exit, I mean when the asset is sold at the end of the life cycle, or the life cycle of the investment. So let's say here in the graph on the right, you can see an asset that was held for 2 years, and it was supposed to be held for 3 years, right? So the sponsor on this deal exited this deal ahead of time at a lower exit price. However, the IRR of the deal, the return on the investment of the deal, was higher than the one projected, right? However, the equity multiple, which is really what tells you for 100,000, let's say an equity multiple of 1.61 tells you if I invested $100,000, I receive $161,000, and that adds all the distributions you got during the life cycle of the deal and the exit, right? But most of these deals become cash positive, well, not cash positive, but accumulative cash positive at the moment of exit. So it's very important. The exit of the deal is the single most important thing that you have to look at. And how does a commercial real estate investor look at the exit? The NOI is very important. The NOI, let's remember, is the income minus the expenses. And what results there is the net operating income, NOI. So the NOI at exit is very important. So usually sponsors acquire assets and increase the value of that asset by increasing the NOI. So the NOI at exit is very important, and this is something sponsors can't control. Cap rate is also important, but cap rate is market driven, and not even real estate market driven, is driven by the economy in general and what the Fed is doing and what opportunities are there for investors. So you can control the NOI, and that's very important at exit. This is an example of a report, and once you are on the deal, and how do you know if things are going according to plan and your investment is performing? There's one thing that is very important to look at, and that's the DSCR. DSCR is the debt service coverage ratio, and that really is the ability of the deal to pay debt, right? And is the NOI divided into debt service, if you want a little more detail about that. So if the deal falls below 1.2 times NOI, 1.2, that's when the deal may be an issue, right? And you may be breaking some covenants with the lender and whatnot. So it's very important to track these things. The DSCR is the single most important thing you need to look at on that report, because if your DSCR falls below 1, that means that the project is not able to cover debt service, and that's a huge red flag, because either you cover it with reserves if you have reserves, or you have to put more capital into the deal, or if you can't put more capital into the deal, this deal may collapse. You may lose all your capital. So this is very important thing to look at.
Hey, Andre.
Yes.
Just a reminder, we've got 4 minutes left in the meeting.
Okay. So I want to present this an example of. I got a question about first. Daniel, I wanted to ask: do we have any more questions at this time?
I don't think we have any more at this time. If people want to put more in, we can certainly do that, but none at this time.
Okay, good. So this is a case study of lifestyle, right? What we discussed. How do we take advantage of these crises, and what asset classes are going to perform? Well, this is one example of an RV park, and where creatively, if we think creatively as a sponsor, we can find deals that cater to that new lifestyle and the new people or people, how people is changing their lifestyle, right? So this is an opportunity of an RV park that I wanted to show here, and you can see the details there. So I'm gonna go to the conclusions here. What is important to evaluate before and during the deal? Again, the systemic variables, what the economy is doing, and the interest rates are very important. The submarket variables, we talked about specific things to look at, but also understanding what's the submarket doing. We have the leading and lagging factors there that we discussed. And then at the deal level, right? First, of course, a good underwriting is important, but is the deal following the plan? Is the debt being serviced? Is there any major risk? And when is it going to exit? The exit is the most important thing. And again, understand that changes on behavior bring opportunity. So cater to those new lifestyles. Innovation is king on this crisis, and let's use those opportunities. So as you've seen, most sponsors are targeting industrial and distressed assets. That's a very crowded space these days, if you would. So a lot of these sponsors are buying high, and that may be an issue down the road. But still, there are good deals appearing every now and then. So it is important to understand that where are these things on the market cycle. So what opportunities are out there? There's a lot of opportunities. Just need to be creative on where you invest these days.
And then, Andreas, in the last moment, can you share your contact information?
Yes. Here's my contact information. Please feel free to call or write me an email at any time.
All right. Thank you very much, Andreas CL, for presenting to us. And of course, you can reach out to Andreas directly at his email address or phone number here. Don't forget that today at 3 p.m. Pacific, we have a discussion group that's going on. So I hope to see you there. Andreas, thank you very much.
Daniel, thank you very much. And thank you, everybody. Great to be here. Take care. Bye.
Thanks to everybody who writes thank you in the chat. We love to see that. Thank you to our guest speaker.